All right, today we're going to dig into a real head scratcher, one of the wildest market reactions I've seen all year. We're talking about Arvinas. That's ticker ARVN. So back on May 1st, they dropped their Q1 numbers, and what happened next? Well, it was a total case study in how weird the market can be. You had this massive monster earnings beat, right? But it was met with an absolute bloodbath for the stock. Just brutal.
Okay, so let's just stare at this disconnect for a second, because it's pretty wild. On the one hand, you've got the beat. And I mean, what a beat. Wall Street was penciling in a loss of almost $1 per share. Instead, Arvinas drops a profit of $1.14. Then you look at revenue. The Street's looking for, what, about $42 million? Arvinas comes in with nearly $190 million. I mean, these aren't just beats, folks. This is a complete demolition of expectations. But then you look at the other side, the bloodbath. The market's reaction, a 31% haircut in one single day. It makes no sense, right?
And, this wasn't just a handful of nervous retail investors hitting the sell button. No. The volume here tells the real story. Almost 17 million shares traded hands that day. That is a huge spike. And when you see volume like that, it tells you this was a high conviction move. We're talking about the big money, the institutions, making a decision and heading for the exits. They saw something in that report that, to them, completely wiped out those incredible headline numbers. So that brings us right to the million-dollar question, right? The core of this whole thing. Why on earth did the market punish a quarter that, on paper, looked absolutely fantastic? Well, the answer, and you see this all the time in biotech, it has nothing to do with the numbers they just printed. It has everything to do with what's coming next. See, the real story wasn't hidden in the balance sheet or the income statement. Nope. It was buried deep in what management said on the earnings call. They announced a massive strategic pivot, and that's what the market latched onto. They weren't trading on the quarter that was, they were trading on the company they thought Arvinas was becoming. So let's unpack exactly what they said. So, right behind those shiny earnings numbers, here's what was really going on. Arvinas announced this huge restructuring. First, they totally axed two big late-stage trials for their lead drug, vepdegestrant. Boom! Just like that, the potential market for their top asset just got a lot smaller. Then, they said they were narrowing their focus to just a monotherapy path for that drug. And to pay for all this, they laid off about a third of their entire team and chopped $80 million from their annual budget. This is the stuff that spooked investors. Now, here's how management framed it. The CEO, John Houston, he came out and called it a prudent decision. He basically said, hey, look, the markets are tough right now, so we're making a smart move to stretch out our cash. They really presented this as a disciplined, responsible choice to make sure the company survives for the long haul. A strategic realignment, not a retreat. That was the official story. Right. But the market? The market read a very different story between those lines. What management called a prudent decision, Wall Street interpreted as a 5-alarm fire. And that's what triggered the panic stampede for the exits. So here's the bear case in a nutshell. Investors looked at this and didn't see a smart pivot. They saw a company in full retreat. Canceling those big trials, that just meant their lead drug, their crown jewel, suddenly had a much smaller potential payday. And all that cut-cutting, it didn't look like smart efficiency. It looked like a company that was scared, slamming on the brakes, and basically admitting their ambitions had to shrink because they were running out of road. And just to put this beatdown into perspective, let's zoom out a bit. The whole biotech sector, right, the XBI ETF, it was already having a pretty miserable year, down about 11%. Not great. But Arvinas, it was down a jaw-dropping 69%. So this wasn't just a case of a bad tide lowering all boats. Oh no, the market singled Arvinas out for special punishment. But you know what they say, right? The time to get interested is when there's blood in the streets. Every massive sell-off like this creates a potential opportunity. So let's flip the script. Let's ask the question, what if the market completely overreacted? What's the bull case for Arvinas right now?
And really, it all boils down to two completely different interpretations of the same events. The market looks at the cost cuts and sees a company running for cover. The bulls look at the same cuts and see smart, disciplined focus. The market sees those axed trials and cries about lost potential. The bulls say, no, they just de-risk the whole story by focusing on the surest bet. And the cash position? The market saw the cuts as proof there was a problem. The bulls see the cuts as the very thing that solved the problem.
And man, what a solution it is. Because of those cuts, Arvinas now has enough cash to last them all the way into the back half of 2028. Now, for a small biotech company, cash isn't just king, it's oxygen. Having a runway that long is a game changer.
It basically takes the threat of a dilutive stock offering off the table for years, which is huge for current shareholders. They don't have to worry about the company running out of money anytime soon.
And we gotta remember, this company isn't just a one-trick pony. We need to talk about what Arvinas actually does. They are leaders in this incredible technology called PROTAC. Now, most drugs just try to block a bad protein, kind of like putting a wrench in the gears. But PROTACs, they're way cooler. Think of them like a molecular assassin. They find the bad protein, tag it for destruction, and then the cell's own built-in garbage disposal comes along and just eliminates it. It's a whole new way of treating disease, and the potential of this platform is way bigger than just one drug.
And that amazing platform is not just sitting on the shelf. While everyone was freaking out about their lead drug, Arvinas has a whole pipeline of other stuff getting ready to make some noise, all in the second half of this year. We're talking about a data update for their Parkinson's drug. They're starting a trial for a KRAS degrader. And trust me, KRAS is one of the biggest, baddest targets in all of cancer research. Plus, we're getting our first look at data for a lymphoma drug. Seriously, any one of these could be a major catalyst that forces Wall Street to sit up and take a second look.
Okay, so all of this brings us to the next call. Let's put it all together and figure out what our forward-looking thesis on Arvinas is.
Our thesis is pretty straightforward. We think the market completely overreacted here. They threw the baby out with the bathwater. They got so fixated on the smaller market for that one lead drug that they totally missed the bigger picture. The company just massively de-risked its finances, and there's a ton of hidden value in that pipeline that nobody seems to be paying for.
So if you believe that thesis, here's an interesting, albeit a bit wild, way you could potentially play it. It's an option strategy called a bullish butterfly spread. Now, this isn't a to-the-moon kind of bet. It's a defined risk trade that pays off the most if the stock just grinds its way back to a more reasonable level, say somewhere in that $10 to $15 range over the next couple of years. It's really a bet on a steady recovery as the company starts delivering on its new, leaner plan. And the rationale for a trade like this just circles back to everything we've talked about. You've got a stock that looks incredibly cheap after that brutal sell-off. You've got a lead drug that now has a much clearer, less risky path forward. And hey, the FDA just accepted their application, which is a huge vote of confidence. You've got that fortress balance sheet with cash until 2028, and you've got multiple pipeline catalysts that could completely change the story. So for the next call, our final rating on Arvinas is outperform. The bottom line is, we think the market punished this company way too hard for what was actually a smart, necessary move. The current stock price, in our view, just doesn't give them credit for their de-risked main asset, that incredible PROTAC platform, or their rock-solid cash position. So I'll leave you with this question. Did the market punish Arvinas for shrinking its ambitions, or did it punish them for making the tough but right call to guarantee they could fight and win another day? And of course, just a reminder, this is not financial advice. Make sure you do your own homework.